Well, welcome everyone to the Wise Wealth podcast. It's really exciting to have a full agenda, and I want to welcome our panelists for the discussion tonight. So, Krista, welcome, and Joshua, and Milan. So,
Welcome.
feel free to weigh in, you guys, as we go through some basic agenda items on this presentation. I'm going to welcome, obviously, everyone. We are doing a recording, so there will be a recording of this webinar. And so if you miss some of the sections, we'll be sure to get a link out to you so you can view the webinar after the fact. What I'd like to do for everyone is just show you a bit of an agenda for our discussion today. So let's take a look at that right now. And I'll go up to our agenda and the different topics we're going to cover off. So we're going to have a bit of a discussion. Josh is going to share with us a pretty exciting event for our practice, and it lines up very much with our passion, which is cycling. So we're going to talk about a fundraising event that's coming up, and we're trying to encourage folks in our circle to participate in the fundraiser. Milan's going to talk about old age security and one particular topic around clawback that I think is very relevant for a lot of people. I'll be covering off a market update, looking at capital markets and some really broad themes in that area. And then we'll take a look at will and estate planning. So Krista Clendenning is our special guest speaker. She's got some great content, and we'll have a Q&A on all these topics, but also on Krista's presentation. By the way, as you're watching the presentation, listening to us, there is a section there for questions. And so be sure to use the chat function to send us questions. We'll be keeping an eye on those. And as we go through the event today, we'll be sure to cover off those questions. So the first area that we're going to cover off is the fundraiser. Josh, do you want to weigh in on the fundraiser?
Yeah. So this year is the 18th annual Ride Around the Lake fundraising event. So actually, I was lucky enough to participate in it last year. It was an absolute blast. So I convinced my dad to take along with me this year. So there's about 62 registered, and that was back in June. So that number is likely larger now. This year we were raising money to build two houses for two families. So Habitat sent me an email with their biographies. So one family had to flee Kenya, spent nearly a decade in a refugee camp until they came to Canada. And then the second family came from Sudan. They have two daughters. They're currently residing in Winnipeg housing. Their profile mentioned they recently had their car stolen, so they're in a bit of a tough situation with that. And both families are pretty excited about getting a permanent house where they can kind of build a life here in Canada. So I just also want to touch on just how powerful this event has been in raising money. So it's only been on for 18 years, and it was a really small group for the first while. And last year, actually, they surpassed the $4 million mark. So this small group of people, this year it's going to be obviously over that, but last year they passed $4 million raised in 17 years, which is pretty crazy, I think. I had a small part of that last year. And then, so what the event actually consists of is three days of cycling. So the first ride they're all three are in Kenora. The first ride is Lake Manaki. It's 125K. The second ride is Bunny Lake. You have an option between 100 or 160-kilometer ride. And then the third day is kind of a shorter ride. It's a 60K on Lake Reddit. So luckily enough, the rides they'll have a support team, vans following us and everything, food, water, and bike mechanical needs, which is a bit of a luxury. And so, yeah, if you guys are feeling inclined to throw some money at a great cause, I believe there will be links up in the YouTube description and sent out in some follow-up stuff afterwards. And so both Shaun and I need to raise each of us $2,500, so at least $5,000 total. But I'm pretty certain we can beat that. So, yeah.
Yeah, and we'll keep you updated on our progress with training. I've been doing lots of training, but Josh has been doing zero.
No, I haven't been on my bike once in the last couple months.
And the
just
link,
running.
and those of you that are watching on the live stream, there is actually a link in the description box. And anyone that's registered, we'll send out an email. And if you can help out, it's a great cause. And so we're just thrilled to be able to participate in it. Well, let's go to the next part of our webinar. And Milan is going to share some thoughts on old age security benefits. Many of you probably know Milan, but she's a partner of practice, and she's put her hand up to talk about old age security benefits. And Milan, I'll turn it over to you.
Thanks, Shaun. Well, good luck for both of you in that bike event. Sounds fantastic. Such great cause right there. So good luck with that. So I wanted to talk a little bit about OAS benefits. Shaun, if you can put up the slides, that would be fantastic. And then that way there we can take a look at those benefits together. And yeah, if you can just kind of scroll down as we go through, that would be great. So as you likely know, with OAS benefits, you can start earning those at age 65. And for those that are age 65 to age 74, the max benefit that you can earn is $718.33 per month, and that's gross, so before tax. For those of you between the ages of 75 and older, then that max benefit that you can earn is $790.16. Now, with OAS, it is reviewed on a quarterly basis. So every January, April, July, and October, they do review the OAS and they just reflect on what that cost of living increases are. And then from there, they may increase it accordingly. So July, they did do an increase. So you'll likely notice, those of you that are receiving OAS benefits, that your OAS benefit will have changed between June and July, just because they did do a little bit of an increase for this month. Now, when it comes to OAS, the one thing to note is that part of your OAS may get clawed back. That's also called, it's also referred as OAS recovery tax. But that might get clawed back because of what your gross, so before tax, income is. So when you file that tax return, that's what they base it on. And if when they take a look at your gross income, if your gross income is over that initial threshold of 90,997, then you'll likely have some of your OAS being clawed back. Now, if your income gross before tax is greater than 142,609, 100% of your OAS actually will be clawed back. So it's a good thing to kind of keep an eye on where your taxable income is and see if there's anything that can be done to help reduce that OAS clawback. Now, how is it calculated? Well, OAS is calculated based on what that amount is above the threshold. And so for every dollar, it's reduced by 15 cents. So that basically comes out to 15% repayment on any dollar above that threshold. So what I've done is I've kind of taken an example that we can look at. So if we look at the next slide, Shaun, there is an example there just to kind of give an idea of how that works.
Maybe I'll just
Did
make
you
a
have any?
quick comment.
Yeah, for sure.
Comment. So first of all, Joshua, I'm just going to ask you a question. Are you concerned about your mic's on mute? But are you concerned about whether OAS is going to be there for you, Josh?
I'm not 100% sure what you're asking here.
I wonder if that pension is going to be down the road when you're 65. Do you think it's going to be there? Do you think the government's going to pull it away from
Oh,
you?
that's a good question. Yeah. I don't know. I don't have a crystal ball. What do you think?
That might be. I mean, it's one of those pensions where if you start fooling around with people's pension plans, it's a bit of an issue. People get upset. But unlike Canada Pension Plan, it's not funded. It comes out of basic tax revenues. It's one of the government's largest budget items, right, on their operating statement. So it's one of those pensions that may come under pressure over time as they try to figure out ways of funding it. But I was just curious whether you're worried. So you're not worried yet. So I guess
Not yet, but I'll keep everyone updated in case my worries
excellent.
increase.
Okay. Sorry, Milan.
That's okay. And that OAS benefit is not based on what your income is either, right? So it's actually based on how long you've lived in Canada past the age of starting at age 18. So it has no impact on what your actual income is apart from the clawback itself. So now if your gross income was, let's say, $95,000, and we look at that threshold of 90,997, well, then you're above that threshold by 4,003. So how do we calculate what your recovery tax payment is or that clawback is? So we'll take that 4,003, we'll times it by 15%, because again, it's 15 cents on a dollar. And so that comes out to 645 that you're going to have to pay back over a 12-month period. And so basically what they'll do is they'll divide that by 12, and then your OAS would be reduced by that $50.04. And that will be reviewed on a year-by-year basis based on your tax return. So what your gross income is. And so what can we do to stay below that OAS threshold, right? So there are some strategies that may work for you to help kind of stay below that OAS threshold. So in a married couple situation, you do have that income splitting rule. And that income splitting rule is basically you can split up to 50% of your pension income. And you can also, at age 65, split up to 50% of income from your RIF account. And so that'll potentially help to bring you down where your gross income is, because you can actually push some of your income to your spouse, which may be at a lower income. Another planning strategy, maybe even before you start taking OAS, and that's within your registered portfolio. Any income from an RSP is taxable income. So if you're at, let's say, a lower tax bracket before age 65, and you've done some tax planning, you may want to look at moving some income or taking assets from your RSP to your tax-free savings account. Because when you start taking income from that TFSA, that is tax-free. So that could be a pre-planning that you can do before the age of 65. The other planning piece may be if your spouse has little to no income. Yes, you can do pension income splitting, but you may also want to look at taking out more from their RSP account instead of yours. You can kind of look at doing some tax planning in regards to how much to take out from those registered accounts. So again, your income is below that OAS threshold. Another tax planning strategy may be deferring your OAS. And I don't know if everybody is aware that you can actually defer your OAS income. So if you're working right now and you're looking at working past age 65, you don't need to start taking your OAS at age 65. You can actually defer it. And so if your earning income is greater than that threshold, then it may make sense to defer your OAS. You're currently working right now, you're not needing the OAS income, might as well look at, potentially deferring that. Another strategy may be to take advantage of your TFSA account. Again, a TFSA, all income generated within a TFSA is tax-free. Interest earned tax-free, capital gains tax-free. So if you've got room in your TFSA and you've got investments and you've got a savings account or non-registered outside of your TFSA that's earning income, which could be bumping up your gross income, well, you may want to look at moving that over from your open account to your TFSA. Because again, that TFSA is tax-free and you wouldn't be needing to claim that as part of your tax return. Right? So those are 4 different types of strategies that you can look at. The next slide over kind of goes over that deferral of OAS income. So again, you can defer your OAS up to age 70. So by age 70, you do need to start taking your OAS. However, when you defer your OAS, you'll actually get a little bit of a bump up. So for every month that you defer your OAS, you'll get an increase of 0.6%. So that's a potential increase of 36%. So again, with that deferral, you can choose when you want to start receiving it. You can start receiving it at age 68 if that makes more sense for you, because you are working still age 65, 66, anywhere's in there. If you'd like to defer your OAS, you do need to notify Service Canada, because I do believe that starting your OAS at age 65, it may be automatic depending on the information that they've received and that they know you're turning 65. However, you would need to notify them and let them know that you want to defer your OAS, and then let them know when you want to start receiving it. And so if it's one of those, you're close to that age 65 and you're wanting to defer it, or even if you started receiving OAS, but you're within 6 months of receiving it, you can actually cancel it, right? So you just need to notify them that that's part of the plan that you'd like to do. So I just think that is one of those things that people may not be aware of the deferral process, but it is good to know that you can, and then take advantage of your full OAS benefit that way.
Mm-hmm. I think that there's two really important takeaways on this. I mean, it's pretty common for us to, when we're doing retirement forecasts, and you begin plotting where the income is going to land over the years, you can see some tax anomalies. So the default for most people is they will, take their Canada Pension Plan early, maybe. They will defer taking RSP contributions. Some people will defer until age 71 when they have to roll over to the RIF and then take the payment in the 72nd year. And what happens is you see sometimes a ballooning of payments. And so their income goes up and all of a sudden they're subject to clawback. So those issues are really important. You want to look into the future and see, what are the trend lines around my taxable income? Does it make sense for me to draw some of that income earlier, expose it at a lower tax rate than getting hit by clawback? So it's just thinking about the future a little bit. And then another piece we've experienced with old age security is when we run retirement projections, sometimes it actually makes sense for people to defer taking OAS. Again, the default is people will take their old age security benefits at 65. Automatically. They just do that. And the same thing with Canada Pension Plan. If people retire before 65, let's say age 60, 61, they start taking their benefits. If you have savings, if you have investments, sometimes it makes sense to actually put pressure on those investments in the early years and defer taking your government benefits into the later years. And we've got videos on our YouTube channel that talks about that. It seems counterintuitive because most people, probably 90% of the people, do the opposite. They take their government benefits as soon as they can and defer using some of their personal assets from a cash flow standpoint. That may not always be the best strategy to employ. That's great, Milan. Any other comments? Josh, are you concerned about old age security still, or is it not an issue for you?
Still a non-issue,
Okay,
but that's good discussion.
Okay. Okay, awesome. Thanks, Milan. So the next piece that we're going to get into is a discussion on capital market update. So I'm going to share with you some thoughts about where we are with the current state of capital markets right now. And so I'm going to start off this discussion on the huge issue that's been in front of us the last year or so, and that's inflation. I found this little image I thought was great. It really underscored the issues. Fast food inflation from 2014 to 2024. While food away from home inflation is up 49% over that time frame. And if you look at various fast food providers, not that we ever go to fast food restaurants. Do you, Josh? I think you pretty much live on fast food, don't you?
Strictly fast food diet. It works pretty well though.
Doesn't look like Krista or Milan do, but
I have a little antidote on this though. I was talking to you
yeah,
about it earlier.
Yeah.
I'd seen recently a video where this guy was showing he gets his groceries from Walmart, orders them online, and he was showing how much it costed him a couple years ago to get whatever his basket of groceries was. And there's an option on Walmart to reorder the same order. And when he had bought it a couple years ago, it was about 142 bucks, I think. And to reorder it, it was over $400. So, which is a little bit, I don't, there might be more nuance to that, right? It was a short video, but kind of paints a not so nice picture.
Crazy, eh? I mean,
Yeah.
but that's a great illustration of what's happened with food inflation and inflation just generally. And so this chart, good old McDonald's up 100% from 2014 to 2024. Popeyes 86%. The list goes on. So it's crazy, the inflationary pressures over the last little while. So for clients watching this webinar, you've seen this chart from me before, but it really underscores the point. Of course, we saw interest rates through 2018 going up as central banks were trying to fight inflationary pressure. There's a little bit of rising inflation. I think the central banks wanted to get rates up higher just in case they had to push rates back down at some point in time. When you know it, COVID hits. And all of a sudden you saw short-term rates just fall like a stone and stayed low through COVID. And then all of a sudden, we see the rise of inflationary pressure, very significant rise, and central banks just started kicking up interest rates like crazy. And that's the world that we've been in. So, politicians are quite proud of themselves. They've sort of curbed the inflationary, pressures, kind of now settled a little bit, but we still have major increases in prices. So the prices haven't really come down, but the rate of increase has been coming down. But it's been a very destabilizing situation for, the average family and for economies generally. Now, this chart's very, very macro, and so we are seeing the tide turn. So you're seeing here where U.S. inflation finally is improving again. We're seeing the same thing in most Western economies where inflationary pressure is plateauing or going down. Inflationary pressure in the U.S. has been pretty sticky, though. So we go into, 22, lots of inflationary pressure. If we look at all items less food and energy, you can see that's the yellow line. The pressure's coming down. And now we're seeing a fairly good correlation both between all items and all items less food and energy. So this is beginning to come down. That's why there's a speculation now that probably the US will reduce rates maybe at least once before we hit the end of the year, maybe this fall. And that's been a back and forth discussion. Are they going to reduce rates? Are they not going to reduce rates? Inflation's been sticky up until fairly recently. Their labor data was pretty strong. There's been some deterioration lately. So it seems like probably we'll see some reduction in interest rates over the next little while. This is a great historical chart. And so it looks at the world's central banks over the last number of years and their interest rate policy. I'm not going to go through all these years, but you can see here, if we go into 2018, that's this yellow here going up. And that was that tightening policy that central banks around the world were beginning to pursue to try to get rates a little bit higher because they were too low for too long. And so they wanted to get rates up a bit. And then boom, all of a sudden COVID hit and we saw central banks going through an accommodation phase where they cut rates like crazy to try to support the economy. We then came through COVID, and of course, through 2022, we saw massive inflationary pressure. And as we look at it historically, it probably wasn't a surprise. Some of the things that were driving it initially were just supply chain interruption, labor market interruption, the shutdown of the global economy. And so we knew that there'll be inflationary pressure. In fact, central bankers were talking and using the term transitory. Yes, we'll get inflation, but it will kind of look after itself. As we come out of COVID and relax COVID policies, supply chains would improve, labor market will be less disrupted, and we'll see the reduction of costs of goods and services. But then unfortunately, the tragic war between Russia and Ukraine hit in 2022. And that just put fuel onto the fire of inflation, where we saw energy prices expanding, exploding, and inflationary pressure. And then central banks started panicking and really began to ratchet up rates to deal with those systemic inflationary pressures. Well, fortunately, we've seen inflationary pressures coming off, and now central banks are in accommodation mode. Now, that's really important for our portfolios because just like interest rates can be destabilizing as they go up for financial assets, they can also be helpful for financial assets as we see rates go down. So we're definitely in this easing rate cycle in many economies right now. So if I gave you a bit of a round the world tour, if I look at Switzerland, Sweden, Canada now, the Eurozone, we've been seeing rate cuts. The big question is going to be, how deep will the cuts be? How quickly are they going to come? Because that does have an impact on our portfolios. The speculation is likely the US will see a cut in rates, at least one. But again, that's an open speculation going back and forth. It's hard to know for sure what's going to happen there. And Japan's kind of the outlier. They might be hiking rates. Of course, Japan was one of the early outlier countries that had negative interest rates for a while, and which is kind of a hard thing to get your head wrapped around. So what are the forecasts? And I'm going to talk about the implication of these forecasts as it relates to portfolios. So if you look at Canadian interest rates, 4.75 is, the rate right now. There's an expectation that by the spring of next year, that rate will be down to 4%. So we could see another 3 rate reductions over the next several months. If you look at the US, we might see the US going from 5.5 to 4.75%. Europe will see rates likely go down, and the United Kingdom will see rate reductions. Now, that's really important for our portfolios, and I'm going to give you some historical information. Now, this is my very poor attempt at, sketching out what happens with fixed income securities or any asset that produces regular income when you see interest rate fluctuation. So let's say you and I have this $10,000 investment. It's going to give me a 4% return over the year. Let's say it does have a maturity date, so 2029. And after I buy that investment, I find that interest rates in the environment go down. So they're now 3%. So I'm holding a 4% yield. Could be real estate, it could be a bond, it could be a preferred share, and rates now generally have gone down. So with most financial instruments, with the exception of GICs or savings accounts, that kind of thing, most securities are tradable. There's a secondary market. So how would you price the value of an investment you already purchased? And let's say you wanted to sell or you're curious as to what it's worth. Well, any income investment is going to be priced relative to other interest rates. So if I get 4%, rates are now 3, that investment might be priced at 11. I've got a $1,000 gain there if I happen to sell. Now, the dilemma is if I sold and got 11, what am I reinvesting at? I'm reinvesting at 3. That's why you would sell at a premium. You need that premium so that when you reinvest at a lower rate, you're feeling like you're still getting fairly compensated. And the reverse is true. If interest rates go up, we'll see the pricing of that asset go down. Nobody wants your 4% investment if rates are now 5. Now, you can see by going through this example, if we're in a situation right now where interest rates are expected to decline, then you'd expect that maybe there's an opportunity in fixed income assets, but even the stock market could benefit. So this first chart I'll just share with you is a chart that looks at the Fed. We always talk about the central bank in the US because what they do really impacts the rest of capital markets. I'm not going to talk about the bond side here right now. I'm going to talk about the stock market, large cap stocks. If you look historically, I'm looking at 6 different major interest rate cycles over the last 40 years. And whenever the Fed kind of paused rates, and eventually we saw rates going back down the other side, large cap stocks were up on average about 21.6%. And in fact, for many of you, if you're investors, you've seen that happen in your portfolio the last 6 months, 7 months, 8 months. If you look at the last quarter of 2023, you saw a nice bounce up in your portfolio value, and you've seen a pretty good year-to-date performance as well. Most of that performance has come from the stock market because stocks are being priced relative to the expectation that rates are going to fall. So if you're looking at a stock and you're an analyst and you're trying to price the value of that company, you're going, well, if their debt servicing costs are this, but those servicing costs are expected to go down here, then their earnings are going to be higher. They'll have more profitability, which means that stock should be trading at a higher multiple. And that's what you're seeing happen in the markets right now. Those stocks are being priced relative to the expectation that rates are going to go down. And maybe those rates might help that particular company in the sector that it operates in. If rates are low, there might be an expansion in economic activity. How long will it continue? Well, there's always a debate about how much of this gain is already priced into the market. I'd say some of it for sure, but generally speaking, we could expect some continued momentum in capital markets as rates begin to fall. The real-time economic sentiment data is saying, or at least it's positioned right now to be a little more encouraging. What this chart looks at is the Goldman Sachs has this Twitter economic sentiment index. It's aggregating data on this Twitter sphere on the sentiment around the economy. And then there's been an index that's around for a long time. It's called the University of Michigan Consumer Sentiment Index. And not surprisingly, through 21 through 22 and early 23, the sentiments were very negative. But now what you're seeing is improving sentiment by these 2 indexes. It doesn't guarantee the market's going to keep going higher, but it is an important proxy for where people are thinking right now. In spite of the geopolitical stuff that's going on and the uncertainty and the inflationary pressures, there has been some improvement in sentiment. And unfortunately, markets do trade a little bit on sentiment. It's not purely numbers. It's also how confident are investors out there. And that's been improving a little bit. Okay, now this is an important chart, and it looks at not equities. I talked about stock market. Now I'm going to talk about the bond market. And historically, if you look at bonds, and this is data going back from 1992 to December 2023, RBC put this data together, and they were looking at aggregate bond portfolios at a mix of corporate, government bonds, short-term, mid-term, long-term maturities. And they just said, okay, 1 year, 2 year, 3 year, 4 years after the peak in interest rates, when the Fed had stopped hiking, what happened to those rates, a year later, 2 years later, 3 years later? What happened to the total return? So remember my teeter-totter, in a declining interest rate environment, bonds are going to provide return two ways. One is the interest rate on the bond, and the second might be some price appreciation as rates begin to come down. So we usually don't look at bonds as a incredible place for making money. Usually they're put in portfolios because we want a maturity coming due when we need money, or we add bonds to be a diversifier to reduce the fluctuation in our portfolios, because often, not always, but bonds can fluctuate inversely to the stock market. So if the stock market goes down, you might find the bond market goes up, and that acts as a bit of a buffer on portfolio volatility. Those are the main reasons we'd see bonds in a portfolio: diversification, and maybe income for a period of time matures, and I'm going to take that income for income and liquidity needs when the bond matures. But we're in an environment now where, because of that very strong signal I shared, huge peak in interest rates, we're at the peak, we're coming down. If we look at 2 years after the peak, aggregate bond portfolios were up almost 20%. 3 years up almost 30%. So that combination of yield plus price appreciation created a pretty compelling opportunity. It's not a long-term opportunity. It's more of a short-term opportunity over the next 1, 2, 3 years. But it's one of the few times when investors might be able to get their cake and eat it too. A more guaranteed kind of investment at a time when maybe there will be some price appreciation potentially on bonds that investors can ride over the next little while. And so those are the main things I wanted to cover off as it relates to the market update. I wanted to stay very thematic. These are very big forces, but they'll have an impact on portfolios. And be assured that most portfolio managers, pension managers, asset managers, actively managed ETF strategies, mutual funds, those are themes that the money managers that we're using are paying attention to try to extract a little more growth or yield on portfolios. Okay, so Josh, now that you know that, what action are you going to take on your portfolio?
I'm gonna go all in on bonds, probably 100% bonds for the next 3 years.
Fantastic. Okay, so that's the market overviews. Now, for the section of this webinar that everyone was waiting for is the presentation by Krista. And so we're going to turn over the agenda to you, and you can give us a bit of an introduction on your topic. Let me bring up your slides here, Krista.
Sure, sounds good. Well, I've already learned lots from all of this presentation so far. So thank you. I made my little notes about how the OAS clawbacks work. So that'll be very helpful for me going forward. So thank you for imparting your wisdom on all of us. Okay, so I just put together some kind of basic stuff about estate planning, touching on some considerations you might want in a will and some things to think about with powers of attorney and healthcare directives. But where I was just going to start is, what are your general elements of an estate plan, and really what does every person generally need? So there's 3 documents that I am always talking to clients about, and that would be a last will and testament, a will, and that will be dealing with what happens to your estate on death. So what happens to your property? Who does it go to? On what terms? And then powers of attorney and healthcare directives deal with decision-making on your behalf while you're alive, but generally when you're no longer competent to deal with those things yourself. So a power of attorney will provide directions about dealing with your assets. So it enables people to pay bills on your behalf, sell property. If you have support or obligations, follow through on those for you. And healthcare directives are really the flip side of the decision making. So separate from the property and asset and money decision making, what medical and personal care decisions need to be made if you're not mentally competent in making them for yourself, and appointing someone to make those decisions for you. So I think the first thing I was just going to bring up, these are some questions that kind of come up with preparing wills and in the estate plan, and maybe not even the first questions that people always ask, but what happens when a beneficiary predeceases? So we might be thinking in our wills, okay, I'm going to leave everything to my spouse, and I mean, that's all I need to have in there for now. Or going to the next level of, if me and my partner are gone, I want things to go equally between the kids. but I always kind of go successive through. I'm the nightmare person because I'm bringing up all these worst case scenarios and what if a child passes away, but maybe there's grandchildren. Are we passing things through the family tree? So really thinking through where you want your estate to go so that you don't have to update this document all the time. And sometimes people aren't thinking about it. Like I have a will right now that just left everything to a partner, and they didn't go to the next round of dividing things amongst the kids, and both parents have passed away. Blended families. We had bio kids from dad and bio kids from mom, I guess, but come together. So all the estate ended up going to the one side that was bio dad's legal kids. So it's just, there can be all kinds of unintended things if you're not really thinking it through and making sure the directions are in there. Another question is, will your family be sufficiently supported when you're gone? So people can have all different circumstances. Maybe they've been supporting one child more than another. Maybe there's a disability there, a need. Maybe there's actually an intention to equalize for support that we've given one child during life. Maybe there's a need to look at like insurance or something because we're trying to leave more behind for that individual. So just considering those ways that you might need to replace yourself or can carry on any kinds of supports you were providing during lifetime. And for kids, like if you're actually talking about young kids that we have in place and leaving directions for them under your will, you really want to consider terms of trust and who's going to manage the money left behind for those kids. At what age do we actually expect kids will be financially responsible enough to manage that inheritance? Legally, kids will get it at 18, but I think often parents feel that an older age is more appropriate. So trust considerations are another piece there. What else did I have? And different claims. It's always important to think about claims that might come into play. So, Family Property Act, dependence relief. If you're someone that's supporting an individual, a family member that's dependent on you, you might need to carry those supports through after your death or leave a sufficient amount for them. And you deal with the same kinds of equalization situations in a separation. You actually have responsibilities to leave at least a certain amount to a spouse or common law partner in your will as well. So considering those. And if you go through a separation, updating things. So a separation itself isn't going to remove a spouse from your will. It isn't until you actually divorce that they would be treated as deceased for the purposes of acting as your executor or inheriting under your will. So separation can be a big trigger for updating things as well. And I have another question there about what happens if the will can't be found. So I do both estate planning and estate administration, and the missing original will is a common scenario. Our Manitoba court has brought in some new rules that make it a little bit more easier or flexible to bring in photocopies, but you have to provide enough evidence as to why the original went missing. So it's just really important generally to keep those original documents safe and in a place that your executor knows where to find them. And if not, you're in these other alternative processes which add a little bit of cost and energy and time to go through a probate process. Oh, Shaun, I think you're muted. Looks like you have a question for me.
Milan, are there any questions coming in at all?
Nothing's come in so far, Shaun.
Okay.
So if I do have a question that's popped in, then I'll pop in with that question.
Okay, perfect. Krista, could you expand? I mean, there's some probably not uncommon. We've got people who are in second marriages or a separation, they're in common law, whatever. And if they never get around to drafting a new will, that can create some pretty big problems, correct? Or am I over dramatizing?
Yeah, definitely. I mean, let's say you signed your will, 20 years ago, and it leaves everything to the kids, and now you're remarried. That new relationship starts a clock running for what we call family property accounting in Manitoba. So if you separate or you pass away, You generally look at what the couple gained together or lost together during the course of their relationship, and there's usually an equalization to be paid to one or the other. So it's a bit of a shock to people that that kind of a claim can arise even on death when you were together. But the idea is that surviving spouse has an entitlement there and can enforce that entitlement. So they would have a claim against the estate, which is directed to go to those kids from the first relationship under the will.
Joshua, do you have your will in place?
No, but this conversation really making me reconsider getting that going quite soon.
That'd be a great idea.
Do you?
Do I? Yes, I do. Thanks to Krista.
Yeah, the more you know, the more I think you're motivated to get these documents in place, or the more interesting scenarios that you encounter. So being an advisor certainly brings those to your attention, and it allows you to give those war stories and convince other people to do the same.
You know, on this you might have some more comments on the will planning, but the power of attorney piece, it's really interesting how when we ask clients to give us updates to their wills or powers of attorney, and it's not uncommon to have situations where the client either sometimes assumes that an executor is kind of like a power of attorney or vice versa, and they think they have both documents in place. And when you kind of press people for the documents, you find out, yeah, they might have a will, but there's no power of attorney. And so it's really important as we talk about estate planning. It's not just about the property or assets that your will has to deal with, but it's also those conversations about property when you're incapacitated and you cannot no longer make decisions and somebody has to step in for you. So that's the lead into a power of attorney.
For sure.
Before we jump into the power of attorney, sorry, I do have a couple questions that have popped in since.
Oh, perfect.
One of the questions, Krista, is what your thoughts are regarding online wills.
I mean, look, as an estate administrator, that's fine for me because I get paid about 3 times as much later to solve all the problems that tend to come up with them.
Oh,
So-
Krista, you got to be kidding.
No, honestly, I honestly had one today where someone told the family, yeah, just print it off online, make sure it's at least a Manitoba form, and you'll be fine, good to go. You don't have to deal with another lawyer. But, you know, wills have very specific requirements. Like for this one, it was missing an affidavit of execution. So every time you sign a will, one of your witnesses needs to sign a sworn statement that they believe you had capacity when you signed it and they were present when all the 2 witnesses and the person signing were there. You need initials on all the pages, which people don't realize. So there's just these technical requirements for signing. And then there's the actual advice portion that comes along with things. So, I mean, every person's different. Your assets and your family tree and what you're trying to accomplish in your estate plan is different. And until, like, you know, working with your average set of clients, it takes me about 2 hours just to figure out all the base core information I need to put together a proper will, because without all those details, you can be missing something that creates a dramatic problem for you later. So online wills, you couldn't do them, and you might be the really lucky case where we can track down the witness later and find get the document signed that we need or rectify the problems. But to the extent I see them, they usually have sufficient enough problems or significant enough problems that it ends up creating more work, cost, effort later, in my view.
Can I throw something out? And Krista, you
Yeah.
correct me if I'm wrong. Okay, I might be overstating the situation, but I remember talking to John Boiser with your firm, and it was on estate litigation. So litigation either against powers of attorney or executors, or people defending themselves against litigation. And I think people would be surprised at the amount of actions that are taken by representatives, by family members. We live in an age where families are kind of, broken sometimes, or second marriages. And boy, if there was an argument for having a well-drafted will and power of attorney, to me, it would be in situations where you're trying to protect yourself and make sure that your professionals are looked after from a potential liability standpoint. The tighter that document and the more advice and counseling that that representative gets from the lawyer. Here are your responsibilities. Here's what you need to be doing. And if you step outside, these statutes or what you're supposed to do, you open yourself up to litigation. Any comments on that? Do the two kind of side by side in terms of the document themselves and the coaching that you do?
Yeah, I mean, the fighting after, it's people react strangely to different to death, and then also different to money situations. So it can really, it can also kind of bring out issues or little things that maybe were underlying before amongst the family. So yeah, it's just like it's a very ripe time for emotions to erupt and then to turn into a fight over something. So even that will that has issues with it, that will happen to have, that I was looking at today, all the money going to one of 3 kids. So the other kids might say, well, I don't think that's a real will, and maybe it was all legitimate and everyone would have expected the money to go to one direction, but like it creates an atmosphere for fighting for sure. So I think, yeah, I mean, getting the proper advice and looking at those documents. I think the other thing is communication with the family or your executors, and sharing, especially the more complex things might be, sharing those documents maybe with your executors or with your attorneys, and having a discussion about their role in advance where they still have the opportunity to ask questions. And when estate plans do have some sort of inequality amongst the kids, or someone's getting more, or someone's getting the cottage and someone's getting something else, talking those through instead of letting that be a surprise on death. Because I think having it come from the parents themselves rather than having experienced the situation after they're gone and they can't really get an explanation. Communication also tends to help things. Yeah, is that answering your question?
Yeah, no, that's good. Now, I think there's a couple more questions, right, Milan?
So basically, we had another question in regards to a business will. So if you can explain what a business will, who needs it, if they own a small business, would it be part of their personal will?
I'm not sure. So a business will, like a direction about what's happening with your shares in a private company, maybe? Almost like a secondary will. Shaun, is that what you would take that to mean?
It might be. I've not been privy to actually a structure like that.
Yeah.
Because
If they want to provide any more clarification on that, because I'm not really familiar with the term business will, but what I might guess that would be, so sometimes secondary wills, there's a very interesting structure where you'll do a primary will and a secondary will, where you have shares in a private corporation. This would be a strategy these days, more common maybe in Ontario, or it would have been common here prior to 2020 when we eliminated probate fees. So it's often a strategy to, when you're going through probate process here in Manitoba, you would include all of your estate assets in a inventory. And we used to charge, the province used to charge a probate tax on that. So it was a 0.7% tax. They did away with that in 2020. But if you had a multiple will, a second will that was working in tandem with your primary will, you could have your shares or like valuable artwork or something else you can transfer without needing probate. You could have those dealt with under a secondary will, and that would avoid having taxes, probate taxes, payable on all those shares in the corporation. So it was a tax saving strategy. That could be what they're referring to.
okay, yeah.
Yeah.
And
then just one last question. Right now we've got just in regards to estate tax. If you can explain more on it, where their question is, do you have to pay tax on primary residence after death of both spouses? Now, I'm not sure if this is somebody that lives in Manitoba or outside of Manitoba. So obviously there's differences between provinces when it comes to estate taxes and probate fees and that.
Yeah. So there's different taxes that come into play. That's what makes it fun and interesting and too complicated to track. But Generally speaking, if you have a primary residence, a house, and you and your spouse own that house together, no cottage, no other property, that one house, you will have a principal residence exemption, which applies to any capital gains in that property. So you would not pay any capital gains tax or income tax on the increased value of that home. If you have a second property, let's say a cottage in Ontario, any increase in the value of that property, if you're not treating it as your principal residence, you'll have to pick between that house and that cottage. Then you would be having to pay capital gains tax on the death of the last spouse at that stage. So that would be kind of the principal residence exemption and capital gains, how that piece works. Estate tax is this one that will vary province to province. So I always make the joke to clients now that Manitoba is a good place to die because we don't have probate taxes anymore. So if all of your property that you own, like land, is in Manitoba, and you die resident in Manitoba, you're not going to have to pay any probate taxes on any of those assets. If you have all that, the house here and the investments here in Manitoba, but you've got that Lake of the Woods cottage, that property you will get hit with, I think it was like a 0.5 or 1.5%. There's a percentage probate tax in Ontario where you'll go through your regular probate process in Manitoba, and then you'll take that court order you get from Manitoba and bring it to an Ontario court, and then you pay probate taxes there on the cottage only, and then you need to go through a court process in Ontario to get legal control over the cottage for your executor, so they can then either transfer it on or sell it, whatever they're doing. So that's the estate tax, like estate tax, probate tax. That would be the Canadian concept. And then you will see estate tax in the US as well. So if you're now like a dual citizen or you're resident in the US, then you're opening all kinds of other crazy doors. But
Yeah, like I think that just one more comment on the tax thing. I mean, as long as you've got, with a partner, typically there's a complete rollover and deferral of all taxes. So if there's a beneficiary on registered account assets, TFSAs, joint registration on property, it can all be a rollover to the surviving spouse. Where the tax issues really hit is in a last to die scenario. And that's where some really important planning needs to be done. And you need to quantify what the potential tax hit's going to be, particularly for families like that. They have large, like you look at farm families, or families have, cottage real estate in Muskoka or, Lake of the Woods. Sometimes there's families where, a few generations ago, grandpa built the cottage, and over the years it's grown to very significant valuations. And so estate planning is not just about using powers of attorney and wills to make sure there's an orderly distribution of assets, but estate planning is also looking ahead and saying, how are we going to deal as a family with potential taxes that will be due in a second to die scenario? And that's where a lot of the tax liabilities get triggered. Thanks, Krista. This is a great slide that you have here.
Sorry, Shaun. I just have a follow-up question from that last piece.
Okay.
There's just an additional question in regards to, so there's no estate or probate tax for primary residence in Ontario after death or both spouses. Is that correct? So I don't know if you can answer that because you're mostly based with Manitoba, because I know it's on a month or province by province basis, right? So I don't know if you would be able to answer the question in regards to no estate or probate tax for primary residence in Ontario after death or both spouses.
If your primary residence is in Ontario, and you die, if your primary residence is in Ontario, you would get hit with the probate tax in Ontario.
Yeah, correct. There's no capital gains tax, but there would be probate tax. Yeah. So that's why everyone that lives outside of Manitoba needs to move to Manitoba. It's great. Yeah. It's great. We've got a great province.
Come work with us. Yeah. I just wanted to go to Shaun's last point there too, because I actually find it kind of funny on the estate administration side, where I'll have some clients who are working through an estate of like the last to die of a couple, and usually things just are more complicated because you are dealing with all the tax issues and just all the stuff that comes with the joint assets and property and distribution of a couple now that they're both gone. And those clients that have experienced, like maybe one of mom or dad passing away first and say, well, things were so easy back then. We didn't even need a lawyer. We just everything rolled over and the house is already in joint names. But yeah, like things are generally a lot easier when one spouse passes if things are structured in a way that makes it easy with the rollovers and the joint property and everything. You often don't even have to go through a probate process at that stage. But when they're both gone, the tax man comes and everything else, there's usually a lot more complication at that stage.
Yeah, exactly. Anything else I don't think you really covered this slide off. So anything you wanted to comment on powers of attorney?
Oh, so I just threw up some different considerations when you are drafting a power of attorney. There's lawyers at my office that actually view the power of attorney as maybe the most important document for people. And when we talk about our litigation department, they can also be kept quite busy with like misuse or abuse of powers of attorney because there's a lot of unfortunate things that go on there. But the power you're giving to people with this document is substantial. Like they are able to step into your shoes and really do anything with your property that you can do. So I always have a discussion about trust, and if your trust in the people you're naming in this document ever changes, update it right away, because another couple $100 to do new powers of attorney is always better than like having an untrustworthy person in the role. Yeah, and then just some qualities there. So, Shaun, I know we've had the discussion about springing versus immediate powers of attorney, and different folks always seem to have different preferences, but an immediate power of attorney is immediately effective. So it can be stored away in that safe location. And if something happens, your child or family member can go access it and start to act right away. Other people don't like the idea that there's that document out there that can be accessed and someone can start to act, maybe without your knowledge technically. And that's when I have clients that prefer the springing option, which actually may require a doctor's signature to bring it into effect. So a doctor signing off that you've lost capacity to manage your own finances at that stage. Yeah, so just those are some qualities to kind of consider as you're drafting powers of attorney. Do you want me to speak to the other items more?
Well, I think from practical experience, I'm not a lawyer, but there's a couple there that I would just make comments on just based as a financial practice. Executorship typically, different from power of attorney, is kind of like a one and done thing. Like it's typically over a more finite time. Here are the tasks, get them done, and you get on with your life. A power of attorney can be completely different. So when you agree, now particularly, husband and wife will be a crisscross, right? Or a partner. But if there's not a partner and now a family member has put up their hand, they're goodwilled, yes, I'll be your power of attorney. But for anyone out there in the audience that has served as power of attorney, it is a big responsibility. It can be very time consuming. It can gobble up a lot of your life, particularly if your loved one has a lot of health issues and there's doctor's appointments and you're helping with tax returns and financial issues. And so that being said, I really think that compensation for powers of attorney in certain circumstances is a completely legitimate conversation to have. And I suspect that it isn't had enough. And so if you are a power of attorney, you're drafting, updating it, and you've got a loved one who's going to step in and you don't have a partner, I don't know what your comments are, Krista, but I think that's a fair conversation to have, because I think with executorship, it's kind of built into the act in terms of compensation, but I don't think it's the same way for power of attorney. Is that correct?
No, that's right. Yeah. So if you're expecting your attorney to be compensated, you really need to have a compensation power, even if it's just general. Like often I'll reference the Trustee Act, which is the same basis for executor compensation that we have. But if you don't have a power that authorizes compensation, the starting point is that you're then not able to take it. So it's a job you're now doing for free, and that could be a very, very big job. It usually isn't a little job.
Yeah, exactly. Yeah. A very important document, and it doesn't have to be overly complicated, but it should speak to those basic issues. One of the things I will say about Krista and their firm, I think you take pretty seriously when someone's appointed executor or power of attorney, the role of coaching that individuals in terms of what their responsibility is, and to make sure they're fulfilling, that responsibility well. So there's no, backlash that comes back to them because they've missed some important steps. Would that be correct?
Absolutely. And I think education for anyone that's either stepping in as an executor, stepping in as an attorney under a power of attorney, or as a trustee for a trust, if that's coming up. A little bit of education at the outset will usually prevent like a world of various mistakes that come up. Like one of the ones that's on that list there is the no gifting thing. So if a power of attorney doesn't have a specific authorization to make gifts to family members or to anyone else, there's no ability to give an early inheritance or to, continue to make charitable gifts even that were made $100 a year at Christmas or something. So that's a common mistake with attorneys. And the accounting, like there's also a legal, whether it's in the power of attorney or not, there's a legal requirement and obligation for an attorney to account once a year, providing a statement of all the funds received and dispersed over the course of that year to the nearest family member, depending on the family structure, who that is. So those are things that your lawyer would hopefully alert you to in doing that initial consultation. And then in today's world as well, with all this new compliance coming in with CRA, in any of these roles, you also really need to be talking with an accountant and making sure if there's any, CRA reporting you need to be doing, or like tax returns, make sure everything's up to date. That's all your responsibility as well.
Mm-hmm, mm-hmm.
Krista, we have a question when it comes to the compensation piece of it. The question is basically, does the amount of compensation for the power of attorney need to be specified, or is it a standard accepted percentage?
There's no standard percentage in Manitoba. Unfortunately, it might be kind of helpful. So I will either do something very general, which I'll explain in a second, or we'll do a rate. So we might say, we're going to pay this attorney X $1,000 a year to take on this job, or you can apply an hourly rate. So maybe we know this person's making $100 an hour at work. We want to pay them like it's a job. So we'll just get them to track their hours and pay them compensation at that rate. The way our Trustee Act works in Manitoba, so it's what usually applies to executor compensation. So if you take that whole structure and apply it to an attorney, really what you're doing is usually looking at the hours they're putting in, the work they're doing. Are they doing a good job? The terminology in our actual act speaks to the care, pains, and troubles of that individual. It's kind of strange language. And then from that section of our Trustee Act, we have all these various cases that have come out with totally different scenarios where some people are charging $100,000 in compensation, some people are charging $5,000, and what's appropriate in the different circumstances. And it totally changes with the assets that you're managing, the complexity of what you're doing, the needs of the individual in the case of the power of attorney, like that you're looking after. So the compensation is so diverse. I find a really hard time to identify a dollar amount because we don't always know how complex it will be. We don't even really know the value of money. Like today it's this, but in 20 years, if this power of attorney is sitting around, maybe $5,000 is, way too small. It's like $5. We just don't know. So it's a tough thing to determine, I think.
I think that's a good advertisement for why it's important to review your estate documents, your powers of attorney, executorship. So you're keeping those discussions active and relevant and updated to reflect those things, right? It does change over time. That's awesome. So a very important document. And again, what happens if you don't have a power of attorney? It's a big mess, but maybe you can cover it off for us.
Yeah. So I think every person that has come to me that finds someone's now lost capacity, no power of attorney was ever done. What do we do now? The option is applying to court to be appointed a committee is the term we have here. This is the Britney Spears conservatorship, like the appointment of someone to take control over your finances and manage everything for you because you can't do it for yourself anymore. And the process itself, you can need a couple medical opinions. So it's more on the litigation side when we're going through it, but it costs you a few $1,000s to go through. A standard simple power of attorney that we're doing is $250. So it is a bit of an insurance policy because maybe you have capacity all the way through your life. You're 95 years old, you pass away, you're competent all the way through. You never needed the document, and I guess you wasted your $250. But if you don't have it and you need it, you've got to go through this process. You can also only have Manitoba resident persons apply to be a committee. So if you're a resident here and your kids are all spread across the country or elsewhere, you may not have an option for someone to apply to take on this job. And the reporting and oversight of individuals that are appointed as committee by the court, it's more intensive. So they have to go back to the court every 2 years and do a review, which usually costs money to go like hire a lawyer to assist you with that. And the powers they have are more limited as well. So it's usually a big pain, more costly, more difficult, less flexibility in managing things for the person. So there's usually regrets in not doing it in advance.
Now, this is going back many years ago when it was at Royal Trust. I'm not sure if this is still an issue, committeeship. Actually trying to get in front of a judge. There was a time when it was tough to get a judge to hear the situation, and there was delays, and actually judges from out of province would be coming in and adjudicating. Yeah, so that's not an issue anymore.
I haven't heard of that as an issue lately. No.
But you're right. It's a great insurance policy. Like for $250, you get your power of attorney as opposed to a few $1,000s to get committeeship. Now, healthcare directives, I find when I talk to clients about this is one that just seems difficult to kind of push up the hill and get done. And I'm not sure if it's because of misinformation or a suspicion that it doesn't matter what I do here in this area, the healthcare folks aren't going to listen to it anyway. In the heat of the moment, when things have to be done from a health standpoint, it's looked at after the fact. I mean, there's all these things that kind of swirl around. So I'm looking forward to hearing your perspective on healthcare directives, how to practically use them and where they're good and maybe where they're not as useful.
Yeah, I mean, like the starting point is if you don't have this, the healthcare institutions are following their own policies about who they're contacting and who they'll take instructions from. I think the more important it is for you to identify the person in your family that you want to make these medical decisions for you if you can't. And if it's not, if it's not your spouse or like the one child you have, if it's sometimes we'll have one kid that's a black sheep of the family or something, right? And you're not comfortable with that person maybe making medical decisions for you. In that case, maybe it's more important to have that other individual appointed and make it really clear. So the best thing you can do, I think it's having the document that appoints who you want, having clear instructions, and then making sure that actual document is in their hands and their control, their possession. So if something happens, they can show up to the healthcare institution and wave the document in the air and show, I'm the person, look, I'm named this individual. These are the instructions, because there is probably a fair bit of advocacy required on the behalf of the healthcare proxy to show they're the correct decision maker and that whatever the decisions are to make sure they are followed. I do hear that sentiment as well that, there's not a lot of steps taken to find out if there is a healthcare directive and who's the person and what are the wishes. It's just like follow the regular processes unless someone lets us know this thing exists.
Probably not a good document to keep locked away in your safety deposit box at your credit union or bank.
No, so this is the best one. Like when we sign healthcare directives, we give a copy out to each of, whoever's named in it. Like we'll give them all a copy right away so they have it, because it's the one that there's an emergency. Like we want to know they've got it. They can come down, they can show they're the decision maker. It's kind of the most urgent one, in my view.
So Josh, do you have your healthcare directive in place?
I do not, but I don't plan on getting injured anytime soon, so I'll be
Josh,
okay.
no one plans on it. That's the thing.
I refuse.
And that's, there's a study that came out, that's associated, I think, with Investors Group did this whole study about, people not having wills. And I was getting asked questions about this week or a couple weeks ago by Free Press. And it's true. Like people don't want to think about these things. And until there's usually a triggering event, like, okay, they're going on the skydiving trip in another country, or they've got kids. So that's been a trigger. They buy a house. Like there's a few things that do trigger people into doing these, but it's hard to wrap your head around getting it done or what your wishes are. And my work, if I can just get people in the door or ready to start the discussion, it gets the ball rolling. So I know the regular things to talk them through, and this is how it works, and take time to make your decision, but we'll keep the ball rolling and get the instructions down. And you can always update it, but we want to make sure there's something in place for you now.
Yep, no, exactly. We can talk about that after, Josh. So was there anything here on this particular piece that we need to speak to? I think it's a relevant question. What happens if I don't have one?
Yeah, this is just back to what are the processes that they have in place. So I think there's like specifically the College of Physicians and Surgeons of Manitoba have their own process about who they contact and what steps they take and what extent they have to go to. I think even like our Healthcare Directives Act, it doesn't obligate anyone to search for it. So like people will maybe keep a copy on them in a wallet or something if you can get it small enough to be in there. But there's no obligation, which is kind of odd, but there's no obligation to search out that healthcare directive, which is why you want it accessible to show.
Yeah, yeah. I think that if there was a takeaway from all this discussion, it's really the importance of communication and having conversations and getting your family involved in what your wishes are and the documents you have in place. Where are those documents? I think a lot of times people are appointed as a power of attorney and executor, but there's not great, clear communication and they're not exactly sure about their responsibilities. And again, it's particularly crucial in a situation where your partner's not around and somebody has to advocate outside your immediate circle. That communication is absolutely critical. So thanks so much, Krista.
Yeah, no problem.
So I just wanted to draw attention to this slide. So Krista's been working, the traditional law has been working with our practice for a lot of years. I think we probably started a relationship with John Poyser going back 30 years ago, probably. And Krista's a partner at Traditional Law, and she's been doing estate planning work for our clients for a long time as well. And really, at the end of the day, and principally most of your work's done in Manitoba, but I think you do work in other jurisdictions as well. Is that correct?
Yeah, like our office does a lot of Ontario, Alberta. I'm practicing mostly Manitoba's keeping me busy, but I've got a little bit of Kenora related work is where it tends to be these days. So we do have our lawyers working in different jurisdictions.
Yeah, so as a follow-up to this particular webinar, we'll make sure that contact information for Krista is available to you. Particularly if you've got cottage property in the Lake of the Woods or you're in Manitoba, she does and their firm does great work. So they would be able to steer you in the right direction in terms of advice and helping you to determine whether you need to have a few things attended to or updated in your estate plan. So thanks so much, Krista.
Happy to be here. Thanks for having me tonight.
I think is that it for questions, I think, Milan?
There is.
Oh, there's one. Can you discuss about MAID and what happens to life insurance policy? Now, that's an interesting question. So medical assistance in dying, and I have not come across that particular question before. So that's definitely something I'd have to do some research on. But do you have any experience with that in terms of life insurance? Was typically there are, clauses within insurance contracts that, say this may not pay out if technically there's a suicide.
Yeah, I haven't had it come up. If it's, if it's often the policies when I've seen made, and if there's life insurance in place, the policy's been around long enough where it's vested, it's going to pay out. It isn't the fact that it was made doesn't have whether it was made or suicide. It wouldn't.
It's gone past the contestability period. Is what you're saying?
Right.
Yeah.
Yes.
Yeah.
But I don't know if it would make a difference that it's made in that circumstance. Yeah, I don't know.
So we'll research that, and that's a really good question. Josh, you're a new insurance advisor. Any comments on that?
Well, I guess that you bring up the 2 years clause and if it's past that, then it doesn't really. I wonder if they just start building into the contract where if it's made, then this happens but I don't know.
I could imagine almost like a human rights argument, because if you're accessing MAID, it's because you've got some sort of terminal condition that it's not really your choice. The view is you're going to die eventually anyways from the thing in the short term. So, is it really? I don't know. I could see an argument to be there.
It also, yeah, it gets tricky too because the reasons for MAID differ, right? Based
Yeah.
on jurisdictions, stuff like that. So I don't know.
Yeah. Well,
Interesting.
I want to thank all of our panelists for their participation tonight. And thank you everyone that has been watching the webinar. Thank you so much for your questions. So this is a really exciting adventure for us. And so we're going to be doing these webinars on a regular basis. Sometimes we'll have guest speakers, sometimes we won't. Sometimes we'll have some quick topics that we think are relevant for everyone. We'll get emails out for future webinars. So I'm hoping we can get Krista back for future webinars because there's a whole bunch of topics. I cut down our session quite a bit, and there's a whole bunch of other pieces that we could have gotten into. So Krista, will you be open to participating in future webinars?
I'd love to come back. Absolutely.
Okay, perfect. Okay, well, thanks so much, everyone. We will, for those who've registered for the webinar, we'll make sure that you get access to the recordings. And for those of you that happen to hit the live stream, again, there'll be a recording that'll go on to our YouTube channel as well. So hope everyone has a great evening, and we'll look forward to seeing you at our next webinar.